So today's video is about, is stock investing gambling? And the short answer to this question is no, if you're doing it correctly. I remember when I was first starting to learn how to invest, I was actually working at my job. I mentioned that I was studying investing, specifically stocks and how to invest in the stock market. And one of my coworkers kind of jumped in and said, oh yeah, that's gambling. And for somebody who didn't know the basics, and at that point I kind of did, it would have scared me away. And that's why I feel like this is a very necessary video to inform you guys about, are you really gambling your money, or are you doing something smart, doing something building your future? So first, let's talk about, are you gambling whenever you're investing in individual stocks, not ETFs, mutual funds, basically indexes? So number one, if you're investing in any time window less than 5 years, you're increasing your risk a lot, because if you're investing in less than 5 years, typically you're exposing yourself to the highs and lows of the market. Everyone knows there are recessions and drops in the market that you can't control, and most likely, unless you're Ray Dalio, you can't predict. In my opinion, if you're investing in a time frame longer than 5 years, your risk of losing money is extremely low if you know what stocks to buy, if you're evaluating these companies properly. So in simpler terms, the longer you hold on to the company, the less of a gamble it will be. Second, if you're investing in companies that you don't fully understand, or businesses that you don't fully grasp, you're not going to know the outcome. Just like going to a casino, you don't know the outcome of what your investment's going to be. And by understand, I'm talking about, what is their competitive advantage or moat? Do you know who the CEO is, and if you trust the leadership? Do you know their financial situation? There's a lot of basic investing fundamentals whenever you're investing in specific stocks that you need to understand. And what I'm talking about is Warren Buffett's method of investing. I haven't talked about that yet, but I have linked below Rule 1 Investing by Phil Town. It's a really good place to learn how to invest in individual companies or stocks. So basically, if you know how to identify and analyze stocks based on sound fundamentals, Warren Buffett's long-term method of investing, in my opinion, no, you are not gambling. Now let's talk about indexing or ETFs. Let's pretend you are too lazy to figure out how to identify stocks and actively monitor them over the long run, which I don't blame you. It's amazing to sit around and basically do nothing and see your money grow over time. It's great. An easy way to do this is through indexing or ETFs. If you're investing in index funds, you're typically diversifying your investment across the entire country's portfolio of stocks. You're buying hundreds of stocks across the market. So basically what you're doing is you're betting on the US economy if you're buying US-based stocks. For example, Vanguard's ETF, VTI, is meant to replicate the US economy. What this means essentially is that the only way that you're going to fail here, as long as you're holding long-term onto VTI, the total stock market index fund, the entire country would have to collapse, which I would bet it's not going to. If it does collapse, let's be honest, you've got larger things to worry about. So what is an ETF or an index fund? Basically, it's buying an asset, or you can think of it as buying one stock with little pieces of hundreds of companies. So for example, the S&P 500 is made up of the 5 largest companies in the US. What you're buying is small pieces of all 500 of those companies. So what happens if one of them goes out of business or declares bankruptcy? You might lose that entire percentage, but hopefully, and in the long run, this has been proven, and I will talk about this in just a second, the entirety of the portfolio is going to go up. So it's a very cheap way of diversifying your portfolio and buying hundreds of US companies. So why is this not gambling? What is the proof? Is there data to show that if you're investing in index funds and diversifying your portfolio, is there data to show that you won't lose your money? The answer is yes, there is. According to the book, The Boglehead's Guide to Investing, if you bought a broad market portfolio of stocks and reinvested your dividends, your odds of losing money in any 5-year period is 13%. Make that 10 years and it drops all the way to 2%. Even further than that, the market has never dropped in any 15-year period. In my opinion, that's very convincing. Meaning, if history repeats itself, which I believe it will, buying for the long term, aka 15 years, your likelihood of losing money is virtually zero. So here's a graph displaying all the bear markets since 1956 and how long they've lasted. Since 1956, those bear markets have lasted between 6 months to 2 years. Even in the worst bear market in history, the Great Depression, which you'll see in multiple locations that lasted 25 years to recover from, that's actually incorrect. You would have been back to break even in approximately 4.5 years, according to the New York Times. Think about that. Even the greatest depression in the country's history would have only taken you 4.5 years to recover from. Meaning, if you had held on to your investment, if you had bought the broad market, you would have been back to where you were in only 4.5 years. It's almost guaranteed. Even more proof of this is if you look at how our country highly encourages retirement funds. Typically, the two that you always hear about is the Roth IRA and a 401k. The reason that these work is because typically what your professional or you yourself are doing is you're investing in mutual funds or ETFs. So diversifying your portfolio across the entire market so that basically you can throw your money into the portfolio and you'll never have to look at it again. You're betting on a few of those companies performing very well in the long term, offsetting the ones that don't do well. So typically these retirement funds are literally just built up of broad market index funds. So in conclusion, no. If you're investing properly in the stock market, investing in stocks is not gambling. And this applies to everyone if you are investing in index funds or ETFs. But if that's not your thing and you do want to buy individual companies, I highly recommend checking out Phil Town's YouTube channel, Rule 1 Investing. Again, it's linked down below. And because I don't fully understand the legality of the whole doing finance on YouTube thing, this is just for entertainment purposes only. Also, please subscribe to my channel. I would really appreciate it. Thank you.